Our next speaker comes to us. If you have interest in donating, you have interest in charities, he's going to talk about opportunities for you to take an interest in your property and donating that as a charitable donation, and how that's going to look at saving you money and helping you donate to a charity of your interest. So Levi Miller comes to us from Christian Aid Ministries Foundation, based in Ohio. Levi works with farmers and landowners to gift both real estate, non-cash, and cash assets in a way, in a tax efficient and a stewardship focused way. So give our attention to Levi Miller.
Well, it's good to be here, and thank you for having me. I'm going to see if this works. So before I begin, a quick disclaimer: we are not attorneys or accountants. So whatever I share here, just consider it information. We have to say that. And to set a little bit of a foundation before we actually get into the tax savings and gifting options, I just wanted to lay a little bit of groundwork on the reasons behind gifting. So here's the scripture verse. It says, "Moreover, it is required that a steward that a man be found faithful." So is avoiding capital gains tax or any tax good stewardship? And I just have a question here in the beginning. We like to ask this question. How many of you know the difference between avoiding tax and evading tax? Anyone?
One's legal, one's not.
One's legal, one's not, and we think it's about the difference of 20 years in the pen. So it's not wrong to pay taxes. In fact, we're asked to pay the just dues to the government. But the government has given us some very good tools to avoid taxes, and avoiding taxes is legal. So what we're talking about, we have this question a lot. People ask, well, is that legal? Can you actually do that? And the answer is yes. If we're showing it here, it is legal. So just trying to save taxes is laying up that foundation, being a good steward. I'd also like to talk a little bit about motivation in tax savings. Why do you want to reduce taxes? So just a few questions for you to ponder on. So you can go on vacation, you don't like the government. I don't really think that should be a valid reason not to pay taxes. So you can pay your bills, or you want to help the needy. Some of those could be valid, and the last one obviously is very valid. We feel like tax savings and giving is a hard thing. So we have people that come to us, their primary motivation is to save taxes. They don't want to pay taxes. They don't really care about charity, but they don't want to pay taxes. Don't feel like that's a very good motivation. So just something to think about. So taxes versus needs. We like to consider this as a way of diverting tax dollars to God's work. You end up with less in your bank account, the IRS ends up with less in their bank account, and the needy are provided for. A little bit of a disclaimer here. When you do gifting, a lot of people have the misconception that you can eliminate the tax and have it go to charity and end up with the same amount in your own bank account, but that is not the case. If you are doing any sort of donating, you generally end up with less in your bank account, as does the government. And today I'll be talking about gifting real estate, gifting commodities, because this is I'm assuming more of an ag-based crowd, tax reduction and elimination, and then at the very end I'll talk a little bit about donor-advised funds. So going into real estate, You can donate a portion or a whole. And when I say a percentage here, that's normally what we look at. It's not just we're not talking about parceling off real estate. So if you have a 100-acre farm, it's not subdividing or surveying off anything. It's a percentage of the whole. So think about it as two brothers going into a business or buying a piece of real estate together. They're both on the deed owning a percentage, and that percentage is completely fluid. You can pick that percentage. This is very, very important. I would say over half of the people that call us and want to donate real estate already have a contract in place. And at that point, you cannot donate real estate. The IRS says that once you have a contract, you have sold it. So just really like to hammer home this point. If you are thinking about selling and you have interest in trying to reduce or eliminate the taxes by gifting, call sooner rather than later. You need a qualified appraisal. Another little, just a little point on that qualified portion. Not every appraiser works. We have had that happen. We try to avoid it, try to educate people that call, but sometimes it still happens where someone gets an appraisal and it's not qualified by the IRS standards. We actually vet those appraisals if they're coming through us because we want to make sure that the donor is taken care of. If that appraisal is not correct, the IRS will deny the deduction. So you need a qualified appraisal if you're receiving a deduction. And then the deduction can be carried forward. Typically, we say, I mean, this is, accountants always play into this, but typically it's the year that you donate, you can take a deduction, but if you can't use it all because it's so big, you can carry it forward an additional 5 years. And something else I would like to impress here is talk to your accountants. Some accountants don't know about gifting options. We run into that quite frequently, but some of them do, and a lot of them do. But it's much better to talk to them before a sale. If you know you have tax liability, then wait until after. We had a situation here right after the end of the year. A guy called in and he said, well, I'm in this situation. I heard that you can help avoid capital gains taxes and I need your help. And we asked what's the situation. He said, well, last year I sold some property and I paid off a debt that I had. And now my accountant says that I have a $60,000 tax bill and I don't have the money to pay it. I said, well, it's way too late now. There's nothing you can do. You have to call in before the sale. So this guy was caught in a situation. He never talked to his accountant. He sold it. He didn't realize he's going to pay capital gains tax. And he took the money and paid off his debt, and now he was in a trap. He actually had to go borrow money, I think, to pay his taxes. So talk to your accountant before rather than later. So on capital gains taxes, you have 3 options. I'm not going to go into this very deeply. It has been touched on before by some of the other speakers. But you can pay the tax, you can postpone the tax, and you can avoid the tax. And I also mentioned there with the avoid the tax, in some situations you can't eliminate it all. If your capital gains is too high and your income is low, other than the sale, there's a limitation of percentage you can deduct in relation to your AGI. So you can pay the tax. We don't think that's a very good option because there are other ways to do it. So, but as I mentioned, this is actually the way to put the most money in your bank account from the sale. We try to make that clear so that you don't have a misconception of or misexpectation of what you can receive from gifting. So to postpone the tax, there's another topic right after mine that is about the 1031 exchange. This is a good option for some situations. It can eventually catch up with you, meaning that the tax is not avoided in the long term if you are still planning to sell at some point without an exchange. At that point, you can still do gifting, or there's other ways to eliminate it. Needs proper planning. I'm assuming that will be discussed in more depth. Okay, so on the avoid the tax, gifted portion to charity, you don't pay taxes on the gifted portion. So this is where this tool is really, really valuable. You receive a charitable deduction for the gift. So if you're putting those two together, you not only don't pay taxes on the gifted portion, so you've reduced your liability, but you also get a deduction on the appraised value of the gift. And that can reduce or eliminate the tax, depending on how much you donate. So here's just a quick illustration. You're getting ready to sell the farm, so you make that transfer. We put Cam Foundation here. That can be any charity that takes real estate. You receive those tax benefits back. The gifted portion, when it sells, goes into the kingdom, and that can completely eliminate your tax bill. We had a sale just here at the end of the year in Wisconsin. It was worth, I think it was worth around 1.1 million. That donor, he was older, he had another farm. He said, my children are all well off. I don't want to give them everything. It's just going to be too much. And he had a brother in his church that was interested in buying this farm. He donated 50%. He just wanted to give half of it away. And then the buyer, the interested person, purchased it from the 50% we own. He purchased it from us. And we can sell on installments. So he's actually financed by Cam Foundation, and will be making payments over, I think it's 15 years. Succession plan. A child wants to purchase the home farm. It's another tool. Sometimes people want to give their children a substantial gift, meaning that they sell it for a lot less than it's worth. And sometimes they're struggling with this concept of, well, if I give my home farm to my child for a reduced value, and all my other children are either buying other farms or they're in business or whatever, they're not getting that gift. So instead of doing that, sometimes the father donates a portion to the charity. Child buys from the father and the charity, or it could be that he's buying the charity's portion and the father is giving them his portion. It's a way of making them pay something, but not all of it. And sometimes the father's like, well, I'm selling my portion, and then now because it's going to charity, it's more fair. I'm not getting it, but it's going to charity. It's a way of avoiding that conflict. And as I said, charity, we can finance the sale. We call it an installment sale. And the father reduces the tax, and the child can make payments. And another idea just to throw out here with real estate sales, if a father or if anyone sells a piece of real estate on installments, that's where you sell it, they get the deed. So in the IRS's eyes, you've actually sold it. But then you don't receive the payments in that year. You drag it out over a number of years. It varies. Sometimes it doesn't work. You have to talk to your accountant about that. But sometimes you're reducing your capital gains tax liability because you're spreading it out over a number of years. You keep it down in a lower tax bracket. Okay, kind of shifting over to commodities. Because this is an ag-based crowd, I thought I would mention commodities very briefly. We take quite a few different types of commodities. Eggs, grain's probably the largest one. Hay, cattle, And then that center one is our favorite. It's actually not a commodity. It's an animal. Pets are not considered commodities. But we received a dog named Carmel. And this is a paper trail. We have gift forms where you're making the pledge. You donate it to us. We sell it. If it's with an auction or with the elevator, we're calling them, we're negotiating the price, or if it just gets sold, obviously there's no negotiation. They send the check to us. You do not receive the income. So don't imagine cattle roaming around the camp parking lot, because we never see it. So you need to make the gift before the sale. Again, always it has to be before the sale. We become the seller. Buyer sends the check to us. Donor avoids the income, but you can deduct the production cost like you normally would. So if you're a farmer, you have your fertilizer, your seeds, everything going into the production of the grain, and you donate it, but you still would itemize those costs like normal. So a very quick overview of the standard deduction versus itemized deduction. This is a place where the gifting commodities comes in, where it's very valuable to a lot of people. The standard deduction in 2026 is $32,200 for a married couple. It would be half that for an individual. So you don't itemize until you exceed the standard. That would be charitable giving. There's some other items that would go into that, like medical bills and there are some additional things that can go into that number. But a lot of people with this high standard deduction find themselves never exceeding that, so they're taking the standard deduction, not able to deduct their charitable donations. So by donating products or commodities, you essentially are reducing your income as a deduction would. And then there's also other taxes to consider, like Social Security tax is taxed before any deductions. The self-employment tax and other, like we don't talk usually about state taxes because every state is so different. We mostly just talk about federal. Okay, so donor advised funds. You're probably wondering, if I make a gift of real estate, that could be a substantial amount. What happens with it? Where does it go? Typically, it would go into a donor advised fund. And we normally just call these DAFs for short. So if you hear that term, that's what it's referring to. So once the real estate, commodity, whatever it is that you donated gets sold, the funds come in, it goes into your fund. It has your name on it. It's almost like a checking account. It's not, but gives you the idea. And then you advise distributions from that account. Your church and school, for specific needs within the church, obviously can go to Christian Aid Ministries programs or other approved charities. Just a little disclaimer, we do have the right to reject a distribution request, because once you make the gift, it's not yours anymore. We frequently have that problem where people are really still claiming the fund. They feel like it's still theirs. It's their fund, but they can only advise distributions. It's not theirs anymore. The IRS, you get a deduction for real estate or whatever it is, and the IRS is not going to allow you the control of those funds. And we don't just deny distributions for no reasons. It always has something to do with the values of that charity or church. Some hard lines would be the LGBTQ involvement, and there's actually a lot more charities today that are involved in that and promoting it than you would think. So we will vet every request, and we can deny it. You can remain anonymous if you wish. We have some donors that are actually primarily donating through us because they don't want their church to know where it's coming from. It depends on the church and the view of the people. To some people that's very important. And you can make the distributions over time. There's no time limit. There's expected best practices is that there is some activity going out within every 3-year period. That's not a law, but it's expected best practice. So some people make a large gift and then spend years distributing it. As I said, you can consider it like a charitable checking account. And for us, most foundations that have donor advised funds have different methods of cost and fees. And so we have ours set up a little bit different. We offer it completely free. There's no costs associated with making the gift, except, let's say it's a real estate transaction, we will deduct the actual costs of closing, etc., from the donation. So if you donate $100,000 worth of real estate and the fees are $1,000 or $1,500 to close, that will come out of the proceeds, just like normal. And if there's any attorney fees, we would deduct those. But our own work in it is free. Interest can accrue to the fund. And when we say can, this is actually where we fund ourselves. One of the primary ways is over time with all of the donor advised funds we have, there's millions of dollars sitting as it moves through, and that is invested into like money markets and CDs, interest-bearing funds. And we take that interest off of every account up to $250,000. So if you have less than $250,000 in your account or your fund, it will not accrue back. So that's why it says can. But sometimes people are donating a lot more than that. So anything over that, all of that interest will actually accrue back to the account. So it can actually grow. Usually it doesn't because they're also making distributions, but it's a way of increasing the gift. And then consider bunching your gifts. And this is relevant to real estate because you're making one large gift in 1 year. It's a way of making one gift 1 year and then not making any gifts maybe the next several years. So you're bunching all of your gifts into 1 year and taking that large deduction. Okay, I think I'm about out of time. I'll try to go through here quickly. Just a few last comments, other tools. Gifts that give back. Gift annuities. This is a way of making it a donation and receiving a payment back. For gift annuities, you get a fixed payment for the rest of your life, and if you're married, it can also be your spouse's life. So if one passes away, the payments continue to come until both have passed away. And then when both have passed away, the remainder goes to charity. And this is also, the funds that come in are invested. So let's say you make a $100,000 donation. It can be real estate, it can be cash, and it goes into a gift annuity, and it's paying out, let's say, 8%. It's based on your age when it starts. So let's say it's paying you $8,000 a year, and you live for 15 years. If you do the math there, you actually receive back more than you donated. But that doesn't mean that the charity is losing money, because on the backside it's probably producing 4 to 5% of interest coming back in. So the decrease would only be 3%. Typically, our average is running about 45% of the initial donation. This is a way of making a gift and also ensuring that you have a payment coming in the future. And then charitable remainder trusts are very similar, but they have a few differences. They can be fixed or flexible payments, and they can be for life or for a term of years. They're a bit more complex. Usually this is only for larger gifts, let's say $250,000 or larger. And then again, the remainder goes to charity. We had a situation in Maryland here. Well, I guess it's still ongoing. This elderly gentleman was a farmer all his life, a poor farmer. Like, it looked like he was always living just above the poverty level. He was living in a very old, rundown house, and there was an old farm set in the middle of the farm where his son was, but he was in a high traffic area along Interstate 80. And so he got an offer from a development company for, I think it was $11 million for that farm. It was 75 acres. So he got all excited. He called us up. We ended up meeting with him. He wanted to donate, I think, about 2/3 of that. The other third he wanted to go to his children. And then he was planning to give a significant portion to charity through a donor advised fund, and then the rest would go into a charitable remainder trust where it would make payments back to him for the rest of his life and his wife's, as a way of making sure that he doesn't have to work, and he was getting up to that age where he couldn't work. It didn't work out. He didn't have a will or a trust, but he was also in debt to some of his sons, and the sons didn't agree with it. They want all of that estate to come to them. So we had several meetings. Some of the sons were in some of those meetings, and it's still an ongoing situation. Somebody's trying